Well, hi, ladies and gentlemen. My name's Chris Weston. I'm head of research at Pepperstone, and we're back with Good as Gold. So we're going to be looking at the gold market specifically, looking at the sort of macro influences. We're going to be looking at some of the technicals, the flow, the rhythm, the feel of the market, just to get a sense of the probability distribution about how this could all sort of go in the short term. And I think there's going to be some interesting charts which I think give you a clearer focus about the fundamentals that are playing into where capital is going at the moment and why we continue to take a slightly bullish view on what's going on in the gold market. So let's crack straight on. And again, I'm going to look at the currency market to start. This is the logic behind this is that if I want to take a bullish position and a bullish view in gold, then I want to do it in the weakest currency. So effectively, I'm going to be long gold in the weakest currency. If I want to go short gold, then I want to do it in the strongest currency, and then you're going to get double bubble from the currency effect as well. And at Pepperstone, we do offer gold in multiple currencies. You can do it in the Japanese yen, obviously the US dollar, euro, sterling, Swiss franc as well. So that's where we are. So in terms of the last 5 days, where have you been? Gold in Japanese yen terms has been the best place to be. So you can see the Japanese yen is about 88 basis points weaker to the dollar. If you wanted to be short gold, then you would have done it, worked your best magic in gold in euro terms. So being long of gold in euro terms has been a poor trade. It's been a hard place to be. Being long in dollar terms has been okay, but certainly long of gold in Japanese yen has been the best place to be. And if we have a look at precious metals in Japanese yen terms, apologies for trying to sound a little bit like Dennis Gartman, but you can see that gold in yen terms is up 2% or nearly 2% over the last 5 days. Silver in yen terms has been working quite nicely, up 3.3%. So that's where you're getting your outperformance. If you're active, that's where you're getting your alpha, and that's kind of what you want to look at. So we can be tactical with gold markets and silver markets. We can look at it in alternative currencies. Of course, everyone just looks at it in US dollar terms. And if we have a look at gold in US dollar terms over the last 5 days, you can see, it's done okay. We're up 1% or so. But if we'd done it in yen terms, then we would have done a little bit better. So I think that's an interesting one. I want to have a look at the calendar now because I've got a fly hanging over my face, which is really annoying. But you can have a look at the calendar and you can see that there's a CPI number coming out tomorrow. And I'm saying this before the CPI number. This is really all that matters this week. I know we've got some ECB speakers, we've got some Bank of England meeting speakers. But for me, it's about the CPI number. Now, the consensus is 7.3%. But if we look at the distribution of expectations, you can see the top end, which is Lloyd's, is calling for 7.6 and the low end is 7%. Now, the question that I ask myself as a macro guy is if we were to get 7.6%, would we see a much more pronounced move in the US dollar, in rates, in the Nasdaq and gold, relative to a downside move that we might see in the US dollar on a 7%? So where would the big move come? What would the market be more surprised? I personally see that we're going to see a bigger outcome, a bigger movement in 7.6% than we would see for 7%. 7% still, a very high level of inflation. I know people might start talking about seeing peak inflation, but I think that term peak inflation would probably come if we were to see a 6 handle on the inflation. But I think this is really key. This is going to rock the world. So again, this needs to be on your radar. If you've got exposures over that, this could be a volatility event. Now, in terms of fair value, I'll go into the interest rate settings in a second. I just love this model. For me, everyone uses the 50-day moving average as a kind of a bigger picture trend filter. I like to see markets mean revert around these levels. You do see over time, if price becomes too extended relative to the 50-day, it will mean revert over a period of time. I also like to use the 5-day moving average just for short-term intraday movements. But what I like to see here is, and I've got a setting, my sample going back to 2010. It's not really giving me much of a situation at the moment. But you can see that the price is pretty much on the 50-day moving average. And I just thought I'd throw that in there just because we like to look for extremes. We look at the average line over this period, 1, 2, 3 standard deviations. And we can see that when we generally get above 11% or below 8% as a discount relative to the 50-day moving average, that's when, we can start looking at mean reversion trades and looking to sort of counter trend that with conviction. We're not there at the moment. It's pretty much on fair value. I like to see that, and just want to throw it in there because it just gives me a clearer assessment of where we're going. Now, I think going into the fundamentals, I think this is really important. Let's have a look at what's being priced in now. I want to sort of look at the number of hikes on this column here, because the market by the end of the year is looking for or pricing in 5.4 hikes from the Federal Reserve by the end of the year. Let's go into Canada, into the swaps market, and we can see by the end of the year, just over 6 rate hikes are being priced into Canadian swaps. We go into the UK, by the end of the year, we've got 5 rate hikes being priced in. We go into Australia, by the end of the year, despite the RBA really just wanting to see what happens on the 23rd of February with the wage numbers, they're looking for 4.5 rate hikes. You go into New Zealand, you can see nearly 7 rate hikes being priced in by the end of the year. In Europe, now this is where we've seen that euro really moving up quite nicely. You can see that we're pricing in, well, the effective rate's negative 57 now, the implied rate's negative 11, so we're pricing in about 46 basis points of hikes, so nearly 5 rate hikes over that period. Yeah, it just all seems too rich, doesn't it? It just seems to me, it's just like, well, we're going to get quantitative tightening. In Canada and the UK, we might even see active sales. So the bonds that the central banks have picked up through QE, they're not just going to allow them to passively roll off, but they're actually actively going to be selling them back to commercial banks. That's properly, aggressive stuff to get their balance sheet to normalise. And then the Fed, we'd probably like to see a major announcement in June that they're going to start quantitative tightening. The bonds that mature, they're effectively going to use the proceeds to continue to buy more bonds and allow that balance sheet to stay and plateau rather than necessarily drop off. And I think that's really interesting that they may reinvest some of the proceeds and cap it. So is the market over anticipating just how much tightening is going to come through? Are they over exaggerating? Well, for me, we come to this chart. And this is what's happening in real rates. So what we've been seeing is bond markets selling off both on a nominal basis across the world and again on a real basis. So when you adjust those nominal bond yields for inflation expectations or real rates, the real rate of return. And if you have a look at US real 10s, you can see they've gone from negative 112 basis points to negative 46 basis points. That is a very aggressive move. Europe's been even more aggressive in terms of their real rate structure. It's been, this move up in real rates in Australia has been very aggressive as well. But look at the gold market. On times gone past, like we've been seeing in 2020 and going to 2021, if real rates were moving higher to this extent, you would see gold getting absolutely taken to the cleaners. You would be seeing it getting creamed. And that hasn't happened. And when something's supposed to happen and it doesn't, it tells you a very clear message. And what does it tell me about gold? Well, I think personally, people are using gold as a hedge against a potential policy mistake. We can short duration in the bond market. We can trade the here and now. We can buy dollars. We can sell dollars. We can do whatever we want to do. But if the central banks are going to pivot because we start seeing inflation starting to drop, we see demand in domestic markets starting to drop, we start seeing housing metrics coming under pressure. If the central banks are going to do an about turn, maybe financial conditions tighten so much that central banks are now, it hits the strike price and effectively the put's been in place, and central banks then have to start walking their communication back, gold is going to absolutely fly. So we buy a portion of gold now in the portfolio, 5-10% as an insurance against the central bank pivot. I think that's what's happening now. People want to have some insurance against that scenario playing through. We can trade the here and nows, but you know what? We've got a percentage of our portfolio as a pivot hedge effectively, and that's the way I look at it, against the central bank mistake. We can use gold in that situation. And I think this is what this chart is telling me quite closely at the moment. Now, having a look at what's happening in the volatility market, I think this is really key for me because it tells me so much about semantics, but also about expected movement. If we have a look at 1 week implied volatility, it's trading around 12.95. It's just really going sideways. And the fact is the market is just not expecting powerful moves, big moves up or down. They're not exploding. So the market is telling me that right now we're probably going to see this continuation of a grind. It might grind lower, it might grind higher, but we're not going to see big impulsive range expansion moves. That's really important whether you're a price action trader, whether you're a systematic trader. Just understand that markets is continuing to expect a grind going forward. If we have a look at risk reversals, which look at the skew of call volatility or put volatility to call volatility, you can see they're negative 67, which tells me that there's a skew towards put volatility. So if the market's saying if we are going to see a move in gold, it's probably going to see a more explosive move to the downside, but it's pretty neutral. It's not that bad at all. If we were down at sort of -2, then I'd say the market's probably looking for at extremes and maybe some contrarian views because there's too much pessimism priced in, but it's quite neutral in that capacity there as well. And then looking at positioning, if we have a look at managed money, we can see we're at 62,000 net long contracts, not at any kind of extreme. So sentiment's pretty neutral on gold. tells me that the market is not overbought at this moment at all, and I think that's fair. Now let's go into the technicals and see how this all sort of comes together. I talked about gold in yen terms. Well, look at that. That's just pushing this ceiling that we've got at the moment. If this breaks through, I think gold in yen terms starts the bull trend at the moment. I think that's a really interesting setup. We obviously just want to wait for that to go through. We've had a number of tests through here. We've been holding this 50-day moving average. I really like that, and we've just seen 5 or 6 days in a row. Now we're testing this ceiling. If this breaks through here, if I'm running a momentum strategy, a trend following strategy, I'd be looking at this, maybe add in your classic sort of your breakout strategies. I've got a Donaldson band there, and again, if this breaks out, you'd be looking for, depending on your look back period, I think this would be quite interesting. I really like in this situation to add a Bollinger Band. And what you tend to see there is the bands. I've just got this on a generic two standard deviations from the 20-day. But what I really like on this situation is you can see that the bands are closing. And obviously that's just a reflection that we've got this sideways trend playing through. And then what you want to see is the band starting to expand. So I can add in a few other indicators that I've got, band width, percentage of band, and you can see the band width's obviously trying to stay and expand. I love that. So we get the breakthrough. And then what we want to see is that the price is holding the 5-day exponential moving average, and that continues to go up. So you get band expansion, and you've got price holding that. And if that can close above this level, then I think that's going to be a really good long trade to play through. So just wait for the market to come to me, and I'll be looking to get into there. Let's have a look at gold in US dollar terms, because that's obviously where all the flow takes place. I want to just bring us back to a weekly chart, because I think this setup just tells you everything you need to know there. So you've got this great little rounded bottom here. I love that structure. I'm just going to remove the Bollinger Band because we don't need that anymore. And then you can see we've got this series of lower highs playing through, kind of broadening phone pattern on the weekly chart. This just defines everything that I'm looking at the moment. It's constructive, but it'll be far more constructive on a close through 1845. I'm going to think that that's going to be on a lot of people's radar, especially if we see higher implied volatility on the back of that. If we can break through 1853 on this high, this reversal that played through, all of these people who sold there on the wrong side of that. So we get a break of the downtrend. That's very powerful. We get a break of 1852, 1853 on a closing basis on a weekly close. I think we start a new bull trend in the gold market. That's a big call, but I think that's what it would tell me in that situation. It's a very powerful move indeed. So they're the two levels I'm looking for. Obviously, on the downside, if we're going to see a more protracted bear market or bear move, should we say, 1783 is obviously the key level on the daily chart, on the weekly chart. Let's bring it into a daily because that's given us good oversight. But you can see we've got double bottom effectively. So you've got that's the level that we're going to potentially project up to into these levels up here. And we've got this really nice little move where we're seeing lower highs playing, or sorry, higher lows playing through. It's trending higher. It's holding the 5-day exponential moving average. So on probability terms, it looks like we're probably squeezing to 1845, and then obviously shit gets real in the sense that we're above those levels. But of course, we need to have an understanding what's happening in that CPI. So it wouldn't surprise me in the short term we go into a bit of a holding pattern. We move a little bit of sideways into CPI numbers. And then obviously, if we're trading gold, we want to see a situation. If you're bullish gold, you want to see a situation where that CPI number, in my opinion, comes out weaker than expected. If you can get a 6% number, then I think gold absolutely flies, because in that situation, then real rates go lower. I think yield nominal treasuries go lower. The dollar will sell off and gold will rally on that. And people will say that there's a policy mistake and all this rate hikes that are priced in might come out. Well, an element may come out. Obviously, the risk is if you get a really strong number. I know people like to say that gold is a hedge against inflation, but in my opinion, I think my thesis being that gold is a hedge against a policy mistake. I think we need to see a situation where you want to see a weaker CPI number for me in that regards. But we'll have to trade price and we'll react to price flows. And I think obviously be watching what happens in gold in yen terms as well there. So for me, fundamentals aside, if we can get a break and close above these downtrends, then I think gold's off to the races. A break above these highs here, all these people are offside. We get the neckline coming in, and I think gold rallies as well. So I'm taking a bullish bias at the moment. Not sitting on any long positions at the moment, but I am looking to wade in on as and when we can get a close above that. I think it's going to be very powerful stuff. I think we'll probably see it front page, and heavily talked about in social media channels there as well. So one to watch. Obviously, if you've got any views, just feel free to share them to me. I know a lot of people will disagree with some of the things I said. That's absolutely fine. That's what makes a market. But very, very keen to hear your views about what's going on in interest rates, the rich pricing we're seeing. Can it get more? What can take us higher? And go from there as well. So obviously a fascinating time in macro. And yeah, obviously keen to see your views. So yeah, good luck and hopefully trade the CPI numbers well. Take care.